Great to be back here with everybody. Thanks for that nice introduction. I thought what I might do today is talk about the U.S. economy and my views on where it might be headed. But I'm just as interested in learning from your questions and comments. So after we all speak, I think we're going to have some time for questions at the end, and I welcome those. What I'm going to give you is my view and not that of anybody else in the Federal Reserve System. That frees me up to say exactly what I think, which is good. So I was trying to think about the economy and how to describe it, and I drifted back about 30 years. And 30 years ago, in my former employer, I participated in an outdoor team building program, which is designed for executive development. And one of our tasks was to climb up a telephone pole and then stand on top of it. Now, you might wonder what that has to do with team building. I was younger then, but I didn't run to the front of the line. Instead, I watched colleague after colleague climb the little metal pegs on the side, but then lose their balance as they tried to climb off the last peg and stand on the top of the pole. They had harnesses, don't worry. It was windy. The pole was swaying ever so slightly. And what happened is that every time somebody looked down to push themselves up to go stand on the top of the pole, they saw the movement below them and they lost their nerve. In time, some figured out the trick, which is you have to keep your eyes on the horizon. If you didn't focus on the pole swaying and the ground moving, you could stand up there with confidence. So obviously, that story came to mind as I was thinking about the economy because it fits what I think I see, which is the ground may look shaky on both sides of the Fed's inflation and unemployment mandate, and that may cause you and others to stress that the economy is about to lose its balance. But if you focus on the horizon, I think the path forward feels a lot more stable. And so what I'll do is, in addition to torturing this analogy through the speech, I'm going to try to take each part of our mandate in turn. I'm going to talk about what looks shaky and then give you my case for why you shouldn't lose confidence. So let's start with the labor market. For the last 6 months, I've been describing businesses as trying to drive through fog. And you know what it's like to drive through fog. When uncertainty's high, it's hard to put your foot on the gas. It's also hard to step on the brakes. And businesses have felt no choice but to pull over and put on their hazards. They haven't been cutting back. They also haven't been leaning in. They're not firing, but they're also not hiring. Instead, what people have been doing is cautiously downsizing through attrition. This sustained caution has put downward pressure on the jobs market. As I'm sure you've seen, recent job growth numbers have been low, with the 3-month average coming in at just 29,000. The hiring rate is near its Great Recession lows. The unemployment rate has ticked up to 4.3%. And even beyond the numbers, it just seems like there's been a noticeable shift in the labor market. If you ask businesses how they see the labor market today, they'll say it's balanced. But as they describe that balance in more detail, it doesn't seem that balanced, with one big exception, which is skilled trades. Otherwise, labor feels quite available, with plenty of quality applicants per job opening. I've been particularly struck by 2 food processors who I've talked to, each of whom lost hundreds of employees due to the revocation of temporary protected status, and yet were able to backfill these hundreds of jobs with little difficulty. These aren't the most attractive jobs, to say the least. If they can be replaced with short notice, that's a sign that the labor market has started to seem a little wobbly. But with that said, if you look toward the longer horizon, there are reasons to be more sanguine. First, labor supply is also shrinking, and it's shrinking at about the same rate as labor demand. Border crossings have plummeted. Some estimates are that immigration will be down by over 2 million immigrants this year. Hundreds of thousands more are expected to lose temporary protected status. In my generation, the baby boomers, continues to age. I'm not, but they are. But just to put some numbers on it, over the last 3 years, the number of people over 65 and out of the labor force has increased by almost 1.3 million a year. There may be fewer jobs to fill, but there are also fewer people vying for each job. And that's what the data shows us. While job growth has fallen considerably, the unemployment rate has stayed relatively stable. Second reason to be more sanguine about the labor market is that demand still remains solid. And it could even get a boost from some of the stimulus that's embedded in the recent tax bill. What happened is that consumers hunkered down in the spring, but more recently, they've resumed spending, especially those with higher income. And why wouldn't they? Unemployment is still low. Today's unemployment rate is as low as it's been in the last 50 years, other than 2 other cycles, 2019 and 1999. Nominal wages are still increasing. Asset valuations are near all-time highs. On the business side, the underlying dynamic is healthy too. Of course, that differs by sectors. You're a lot happier if you're in the data center and power generation sector, and a lot less happy if you're in residential or agriculture. But overall, second quarter earnings were strong. Stock prices keep climbing. Uncertainty seems to be coming down as the path for government policies becomes clearer. We do a CFO survey every 3 months. We run in collaboration with Duke. And it found that business optimism has ticked back up near the levels they hit at the end of last year, which in turn was the highest since 2021. So all of that bodes well for the economy. But even if it doesn't, even if demand were to weaken, I doubt we'd find companies as overextended as they have been before the downturns that we remember. Remember that businesses have been cautious for years now. They've been cautious about interest rate hikes. They've been cautious about premature recession forecasts, and more recently, policy uncertainty. After years of low hiring, they should be less extended, they should have fewer extra workers, and therefore are less likely to need to resort to sizable layoffs. Net, that means while the labor market may be weakening, the downside should be limited. So let's turn to inflation, where I see a similar dynamic. Inflation remains above the Fed's 2% target. It's 2.7% headline and 2.9% core. It's now been over target for 4.5 years. And you can't avoid the topic of tariffs, which we know are impacting input costs, as are other input costs like rising health insurance premiums. For months, businesses have been giving reasons why prices do not yet reflect the full pass-through of tariffs. They point to transit time, to inventory buildup, to longer-term contracts. But while the impact may be delayed, it's clear that they plan to pass on what they can over time. And in the context of inflation already above target, that can make the outlook for inflation seem shaky as well. But again, I look at the horizon, and I'm more sanguine. For one, price setters seem reluctant to make price increases too visible. Nobody wants too much attention. Additionally, productivity growth seems to be improving significantly. And I think what's happened here is that employers got caught short 2 or 3 years ago, and they invested in automation and new processes to reduce their dependence on labor. Then you've got new technologies like AI, and the deployment of that is having an impact, particularly in places like coding and call centers and newer employees. And businesses who are reluctant to hire are finding ways to get work done with less. Higher productivity growth is important when it comes to inflation because it helps offset margin pressure in a way that limits inflation. So we saw that in the second quarter, where earnings grew despite higher costs and limited price pass-through. And finally, and perhaps more fundamentally, while consumers are still spending, we're not in 2022 anymore. Consumers aren't as flush with excess savings. They're making choices. We hear that they're trading down, repairing rather than replacing, moving to private brands, value retailers. They may also be trading off, front-loading the purchase of an iPhone, cutting back on a vacation. And all this consumer pushback means you're going to limit the magnitude of price increases. So the ground may look shaky today, but there are good reasons to think countervailing forces will limit the downside. I'll note, though, the numbers are going to look a little unusual during this period. First of all, they may not get reported, but if they do get reported, GDP growth could slow as population growth stalls without triggering a tick up in unemployment. Job growth numbers could look low while unemployment stays relatively stable. And the mix of relative price changes that we're used to seeing across categories could shift. What does this mean for the Fed? Since 2022, with inflation above our target and the labor market healthy, it made sense for us to focus our attention on inflation. You could say we were climbing the pole at that point. The direction was clear. You just followed the pegs up. Now, with inflation risk still elevated, but the downside risk to employment rising, we face a more challenging situation. We're at the top of the telephone pole, if you will. With our two goals in tension, our focus is more about how do you balance. At our last meeting, we cut the Fed funds rate by 25 basis points to just over 4%, moving toward a more neutral policy stance. The idea is to try to help support the labor market while maintaining pressure on inflation in the interest of keeping the economy on path to that more stable horizon. Thanks, and I'm looking forward to the next couple of speakers.